thanks for being with me today. My topic is proactive investment decisions. The reason I chose the topic proactive investment decisions is because of the fact there's a lot of people out there worried about their bond investments and the fact that the stock market has gone up. And so the question becomes, are we in another bubble? Well, I will tell you that probably one of the bubbles that we may be in is on the bond side. But what happens is when the media hits on the word bonds, they're referring to all bonds. In reality, there's certain types of bonds that may work better in different market scenarios. Also, we're big believers here at File Plan Partners that you have to be proactive. You have to be looking at where you think things will be down the road. And in our investment research strategies, that's exactly what we do. I think it's pretty much a given to everybody that sometime interest rates will go up. And when they do go up, bond values will come down. The question becomes at that time, what type of bonds are you in at that particular time, and which ones may work better based on maturity range, because the further out a maturity is on a bond, the more volatile that bond will be when interest rates go up, and you can see your value go down. So do you shorten the maturities? That's one of the options you do. Do you look at other types of bonds? Case in point, there's U.S. government bonds that are out there. That's a type of bond. There's a corporate bond that's out there. There's emerging market bonds that are out there. There are convertible, bonds that are out there. So just because somebody starts talking in the media about bonds and how they can be impacted with rising interest rates, you need to understand how those react in those kind of environments and then proactively make decisions on them. We're having proactive discussions right now as to what percentage of your portfolio needs to have bonds in it, based on your financial blueprint, based on your age, based on how close you are to retirement. Are you already in retirement? There's a lot of things that go into the decision-making process. But when you've got a scenario that you can see down the road that interest rates at some point here will probably be going up, then you need to go on and start moving in a direction and be proactive on how to realign the portfolios in relation to the financial blueprint. If you don't have a financial blueprint, you really don't know what kind of rate of return you're trying to track anyway. I'm real big on matrix. I'm real big on how do you analyze the overall return of a portfolio in relation to how much risk you need to take and what return you need to get. So we're doing that, proactively here at File Plan Partners. So I hope this has given you a little insight that the next time you go online and looking at things on the internet and it says bonds could be impacted, that you understand, let's break that down in more detail before we do a knee-jerk reaction, and never make an investment decision without a lot of information and understanding what type of investments you're in and what percent it represents of your overall portfolio. I've always liked that line, if it looks like a duck, if it quacks like a duck, if it swims like a duck, it's a duck. Well, bonds work in different ways and you have to get specific. Thanks for the time. Hope you've enjoyed the discussion and that I've emphasized some things as to what we're looking at here at File Plan Partners.